Hi guys, it's Ted here, and I just wanted to share something with you that I noticed. I was watching a video on a financial education YouTube channel where, the Jeremy is his name, the creator there. He talks about a lot of different stock market ideas, investing that he does, and normally anytime someone is recommending an investment or something in the stock market, you have to take it with a grain of salt. No matter what, you have to do your own research. This one is not one that that I've looked at very closely, to be honest. I don't really like to look at big growth companies or technology, what you might call quote unquote technology companies that are fast growers, very heavily overvalued in a lot of cases. It's just a place that I'm not really comfortable, and just looking for growth and that kind of thing, it's just not something that I'm comfortable understanding. But he did recommend Skyworks solutions recently. He said he bought Skyworks solutions. And so I'll just go to his video here. And so it sounded familiar. I wasn't, it kind of made me think for a second, because I had seen it in a screener recently, and I used certain value investing screeners to look for companies that aren't fast growers, but undervalued in relation to earnings and free cash flow and things like that. So, Skyworks Solutions, this one needs a whole lot more research, but I just wanted to share this idea right now. They're in the chip making sector, so they make components that go into smartphones, and 5G is going to be a big thing for them in the future. And this is what he's talking about in his video. I recommend you go and take a look at this video and just see what he's looking at. But here's what I'm looking at, and I'm going to go to this page on Guru Focus. So this is the main page for Skyworks Solutions, and he actually made this video a few days ago. And since he bought his shares in Skyworks, the price has gone down quite a bit. So I think this is probably a case of the entire sector going down and taking everybody with it. So, I mean, we've seen Apple and some of the large tech companies just going down. And it just tends to drag everyone with it. So Skyworks, a big supplier to the smartphone makers, including Apple, today priced at around $71.26. You see that up top. And so, I mean, a lot of green here. I don't want to go too in depth here, but you see a lot of green on the main page. So first thing I love to look at here is just the profitability. So it does have strong margins, and you will see that in certain chip makers. They do have margins. All right, so you'll see other things like free cash flow, positive net income, no debt. So all of these are good things. And return on invested capital, something I think is very important to look at, above 36.5%. So, I mean, the financials just look very good here. So you'd expect a very rich valuation. However, when you look up here near the top, the price to earnings ratio is below 15. So now you start to wonder, this can fit in with a lot of traditional value theory type investing. So above here, you see where this company could theoretically be valued using different models, DCF, earnings based, and all that kind of stuff. And that's really good, but I like to look at the DCF especially, and that you can see here is quite undervalued. So according to that model, you'd see it easily priced over $120, $143 on an earnings based. calculation. So, I mean, there you're probably looking at what is the growth rate that they're actually predicting. And if there's a slowdown, then that certainly affects it. So that's something that I have to go in and research a little bit more. But it's just worth noting right now. So yeah, assuming a 20% per year growth rate over 10 years, that's a little bit ambitious, I guess is the word for it. So maybe you want to pull that back and just see what a fair growth rate would be. So I mean, even going back the past year, earnings have been not growing the way that they have been in the past, but it does have a longer than 10-year history of being able to grow, and that's much the case in a lot of the tech and chip makers sector. So anyway, this one is definitely worth looking at. The reverse DCF model tells you that if it sustains a growth rate of just under 10%, then this is a fair value for this company. So if you think you can grow at that rate or more, I mean, the overall growth of the market is in that range. So this company should be able to branch out and build on its momentum. You know, the Internet of Things is supposed to be this huge thing for this sector. So anyways, let's go to, I want to show you the interactive chart here. I love this tool because you can actually visualize things over time. So here's a 10-year chart, and I've plotted out the median price to earnings graph against the stock price, which is the green. And so median, you can kind of see the legend here. Median price to earnings is going to be the blue, the red graph. I'm just trying to read it now as I'm telling you to. I have the price to sales ratio as well. It's yellow. It doesn't appear all that great on here, but I also added the price to earnings graph at 15. And so, I mean, you'd call this the Peter Lynch chart, and the market historical average of being around 15. And I like to compare that with the actual median price to earnings ratio is. So that's why I'm not seeing it here, because it doesn't actually say it right here. But the blue chart is what the price would be if it had an earnings multiple consistently at about 15 or at 15. And the price, the actual market price, has dipped below that. And so if you think that this company has the ability to remain healthy for the long term and going to continue growing and broadening its product base and all that kind of stuff, and will maintain itself as a relatively healthy company, then theoretically it will bounce around its earnings multiple over time. And so if you go back, this is a 10-year graph, you can go back even further. It's done that. So, I mean, right around 2012 here, it dipped. 2016 here, where the market had a correction around that time, it did that as well. And here again, and again, I'm going to be doing a lot of more research before I ever come close to even buying shares in this company to find out if its competitive advantage is still intact. But the price here is becoming more and more attractive at around $72 a share, below the level where its price to earnings multiple will be at around 15. So somewhat undervalued there according to that basic metric and according to that basic model. So anyways, that's what I'm looking at. And if you're interested in this, go ahead and do more of your own research. And I hope you found this helpful. So, all right, have a great day. Bye for now.